Good morning, students. In this video, we are going to study about factors affecting capital structure. So, what is basically capital structure? Capital structure is the composition of the amount of long-term funds. Means आपके पास कितना long-term funds available है in the form of capital is called as your capital structure. So, long-term funds can be divided into two types. One is borrowed funds and the other one is owner's fund. Borrowed funds are also called as debt. Please remember this. Borrowed funds are also called as debts and owner's fund are called as equity. So, how can we get this borrowed funds and owner's fund? Borrowed funds can be in the form of debentures or in the form of long-term loans, and owner's fund can be in the form of equity and retained earnings. What are retained earnings? Retained earnings are basically the profits which you are keeping as reserve since several years. That is your retained earnings or undistributed profit. Now let's study the ratios. The ratio between equity, what is equity? That is owner's fund, and debt is borrowed fund. So, the ratio between equity and debt, you can say equity by debt is equal to capital gearing or financial leverage. Now, when debt is more than equity, we call it as high gearing or trading on thin equities. And on the other hand, when equity is more than debt, we call it as low gearing or trading on thick equity. So, let's study the factors affecting capital structure. The first factor which affects the capital structure of an organization is the trading on equity, which is called as financial leverage. What is financial leverage? When a business uses debt, that is borrowed funds, along with equity, that is owner's fund, then we call it as trading on equity. Means आप शेयर्स भी इशू किए हो और साथ साथ में आप डिबेंचर्स से भी पैसे ले रहे हो या आप लॉन्ग टर्म लोन्स भी ले रहे हो, then we call it as trading on equity. So, when the rate of earning of a company is higher than the rate of interest at which the funds are borrowed. Obviously, when you are borrowing funds, you have to pay the rate of interest. So, when your earning is more than your interest, then equity shareholders can get higher earning per share because of two reasons. Because the rate of return on investment is more than the rate of interest and dividend payable on debt. If the company is earning more amount of money, then definitely they have to pay more dividend to the shareholders. So, they'll get more dividend when the rate of interest is less than the rate of earning. Secondly, you must know that whatever interest is paid on debt is deducted from profit while calculating tax. Whenever you calculate tax, we deduct your debt, like interest paid on debt, from the profit. So, this is basically the capital structure, trading on equity. Now, when this trading on equity is desirable or beneficial or favorable, number one, when the rate of earning is higher than the rate of interest, I have already told you all. Second is when the company's earning are stable and regular to pay at least the interest on debentures. I want to tell you all that basically we divide it into three parts: equity shareholders, preference shareholders and debenture holders. Whenever a company is earning profit or they are not earning profit, they are bound to pay fixed percentage of interest to the debenture holders, then to the preference shareholders, and if they are not you can say if they are not earning profit, then no need to pay the equity shareholders. So, but they are bound to pay the debenture holders. So, this is favorable only when the company is earning regular dividend. or you can say regular earning. Third is, to borrow fund, a company should have sufficient amount of fixed assets so that they can keep them as collateral, as a security, and get the loan. That is basically your 3 conditions where trading on equity is favorable. The second factor which affects the capital structure is your exercise of control. Now, you must be knowing about it that equity shareholders have voting rights and control over the company. So, if a company wants to reduce the power, or they want to restrict the power to themselves only, then they will issue less of equity shares and more of borrowed funds, because they don't want any other person or any other equity shareholder to exercise control over their company. That is why they'll issue more of borrowed funds. Okay. Third is need for flexibility. Now, a good capital structure should be flexible so that whenever they need, they can be adjusted. You must be knowing that I have already told you all, debentures and preference shares can be paid off. Like if you don't require that much amount of money, then as your capital, then you can easily pay off your debenture holders and your preference shareholders, and you will be relieved from the burden. Like आपको capital में पैसा नहीं चाहिए, आपको उतना कैपिटल नहीं चाहिए, तो आप क्या करोगे, प्रेफरेंस शेयर होल्डर्स को उनका पैसा दे दोगे और वहीं ख़त्म. डिबेंचर होल्डर्स को उतना वहाँ पैसा दे दिए, वहाँ ख़त्म. बट इक्विटी शेयर होल्डर्स, जब तक कंपनी वाइंड अप नहीं हो जाता तब तक उसको आप रिटर्न नहीं कर सकते हो, तो एक परमानेंट बर्डन हो जाता है आपके लिए. दैट इज़ वाई it should be flexible. If you don't need that much of capital, if you are seeing that there is overcapitalization, then you can easily return off the preference shareholders and debenture holders, but equity share is not possible. So you should keep your capital structure flexible. Now the fourth point is nature of business. If a company is earning regularly, if they are getting regular earning, they can go for debentures, because paying the dividend on debenture is compulsory. You are bound to pay the debenture holders. But if a company is not getting regular earning and their earnings and demand fluctuate, then they will never prefer debentures, they will prefer equity, because they know that they are not bound to pay the equity shareholders if they are not earning that much. Fifth point is cost of financing. Any company should estimate and compare the cost of different sources of finance before making a choice. You must be knowing that flotation cost, that is cost on issuing shares, are much higher than the cost of you can say debt. So a company basically prefer, if a company can go for that much cost, then they will prefer equity. But if they have cost, you can say they have constraints on, they have restrictions on their cost of finance, then they will prefer debt rather than equity. Now the sixth point is period and purpose of financing. It is very important to know that why the funds are required. Basically, debentures and preference shares are preferred for medium term, and for long term finance we prefer equity shares. If a company wants to expand their programs or modernize their programs, they will prefer preference shares and debentures rather than equity shares. Seventh is capital market condition. Now, there are two types of market condition. You can say capital market condition. One is boom and the other one is you can say bearish. Now, during the boom period, each and every investors, you can say they are ready to take risk and invest in equity shares, because they know that the capital market is in the boom condition, means it is flourishing. They will get more and more amount of dividend. But On the other hand, if the capital market is not so, मतलब you can say not उतने अच्छे कंडीशन में नहीं है, तो कोई भी इन्वेस्टर इक्विटी शेयर्स पे इन्वेस्ट करना नहीं चाहेगा, बिकॉज दे नो दे कैन सफ़र लॉसेस, द कंपनी कैन सफ़र लॉसेस एंड दे वोंट गेट एनी काइंड ऑफ डिविडेंड. Next is statutory requirement. What is statutory? Statutory means any laws or any regulations. Banking companies are restricted from issuing any types of securities except equity share. Government of India has also certain rules and regulations of debt equity ratio, means how much debt should be issued or how much equity should be issued. So there are certain rules and regulations which should be followed before issuing the securities. So this should be taken into consideration. Next is needs of investors. If the investor, you can say they want income, high income, and they don't want to take risk, they will prefer debentures, because in debentures they will get regular dividend and a high percentage of dividend, whether the company is earning profit or it is not earning profit. But if the investor is ready to take risk, they will invest in equity shares, because in equity shares, if a company is gaining more and more of earning, then it can easily pay off the investors, and the investors will get high dividend. That is basically if the investor is ready to take the risk. Next is cash flow position. Companies cash flows position is very necessary to meet its requirement and to influence the capital structure. Now, if the company is earning enough profit, but it is not getting capital, it is not getting cash at the time of payment of interest and loan, then it is very problematic for them. The company should properly analyze its position and prepare a cash flow statement before deciding for the debt equity ratio, means before deciding the types of capital structure. These are the factors affecting the capital structure. Hope it is clear to you all. This chapter is very, very important. Please focus on this and try to understand each and every basic and minute details in this. Thank you.